Take-Two Interactive reports its numbers today after the bell. Let's bring in an expert panel to discuss this. We start with Chris Vermeulen, founder, chief market strategist, thetechnicaltraders.com. Let's start with you, Chris, and we're going to go to James on the phone in a moment. Chris, tell me what you're thinking. I mean, I was looking through, and you were talking about PE values, and that maybe this one's a little frothy for Take-Two because they've done so well.
Yeah, they have. I mean, they've been on fire. Their earnings, their profit margins are up, 50% from 2015, or sorry, double from 2015. It's been a good story. They've got lots of new games coming out, like 93 new titles in the works. And, they're really just killing it. And people are excited about anything that's doing well. Everyone is piling into the boat, and it's pushed the PE ratio about 45, which is a lot higher than, its competitors like Activision and Electronic Arts. So it's a little pricey at this point, but I mean, they're doing extremely well.
So let's welcome in James Cakmak, partner of Clockwise Capital, to continue the discussion. James, always love having you on. You're delving into what goes on with Take-Two Interactive ahead of its earnings after the bell. What are your thoughts on the company? Let's hold that thought. Chris, I just wanted to follow up on what you think. If they miss earnings, you think it could be because millions of users are back to work? Is that right, Chris?
Yeah, I mean, I think it's just a piece of the pie. I mean, they've been doing exceptionally well. So many people were laid off, lost jobs, millions. And I mean, since that last quarterly earnings where they really blew out estimates, people are, back into the workforce, not as much time on their hands. So maybe we're not seeing quite as much gaming and purchases in that way. So it could be a little bit weaker than people are anticipating just based on that. But I mean, the growing trend of people gaming is just continuing to climb. So it'll be interesting to see the earnings after the close, because I think a lot of it is going to come down to, how many people are still having time to game and how many are actually back to work, because, we're starting to see quite a few new jobs come into play.
Yeah, I mean, that was the Netflix story, right, overall. Tell me about the others, Chris, quickly. Activision, Electronic Arts.
I don't follow those two closely, but I mean, they're all doing exceptionally well. They've got blockbuster games just keep, really rolling out and taking off. All the share prices are doing exceptionally well, and they're up and to the right. I mean, it's really hard not to want to own these gaming stocks and really any tech online service at this point. I mean, people just continue to pile in. The gaming industry is booming, and you look at its competitors, Activision, Electronic Arts. They have bigger profit margins. So they are definitely the leaders, but I think a lot of people see value in Take-Two because they're growing really fast. They've got 77% profit margins now, which up huge. People are buying Take-Two products online versus buying physical games, and that's why they're making a lot more money. There's a lot of online sales with Take-Two that are really becoming the dominant income stream.
Yeah, and let's expand the conversation and bring in James Cakmak, partner, Clockwise Capital, on the telephone. James, thanks for joining us. We're having a great conversation about these video game makers. This was the time for them with COVID. Is there enough room for the whole group to grow? I know you think that Take-Two is in a smaller position, so is probably in a good space to grow, right?
Yeah, we're bullish on gaming more broadly. Because of the fact that they are a threat to the media establishment. The way we think about it is the media is being pressured, traditional media rather, by the emergence of alternative sources of content, alternative ways of producing content. So there's competitive threats from everywhere. So you even look at Disney's proxy, they talk about Activision as a competitor. So when you think about the space, we think that gaming is going to increasingly encroach as far as entertainment activity is concerned. And you add on top of that the more flexibility in the work environment and everything that comes from COVID in a post-COVID world. We think that gaming is still in very early stages, especially when you layer on emergent opportunities like esports.
And James, just a quick thought after the earnings, because the stock's basically at a high for Take-Two. It's up 16% just over 1 month, a real winner. If it comes out with earnings, first, the last round was so good. But even if it beats and a sell-off happens, would you use that as an opportunity? Because sometimes you get the news and people sell. Would you call that as an opportunity to buy in?
Yeah, in our fund, we are owners of Activision. We don't own Take-Two, but we are bullish ultimately on the space. And obviously, the valuations are somewhat toward the higher end, high single digit as it relates to the price to sales multiple, 25, 30 times on an earnings basis. So it's not cheap. So I do think that you may see choppiness along the way, but the space as a whole, Take-Two being a part of that space, we think has a lot more room to grow as we look into the future.
Chris, what do you think about all the new titles? You said they have 93 new titles. How does this compare against some of the other competition that gaming, Chris, has to deal with, right? Whether it's Disney or the other gaming or Netflix or something else.
Yeah, I mean, you really got to throw a broad net. I think with gaming, you never know what's going to be the big hit. So all these companies have to do a lot of titles, push them out, do a lot of testing, and see which ones really click and stick with users and really turn viral. I mean, they have to keep pushing them out until something hits and it becomes a big success. So I think, they're doing well, really making sure they got a huge lineup of products to come out and really just try to shotgun approach and get as many titles in front of people and see which ones goes, because you never know which game is going to take off. It's always kind of what you don't expect. And that's kind of the whole theory is they've got a lot of products coming, which gives them investors a lot of opportunity because you never know if they're going to get a whole bunch of new hits. So it's really exciting what they've got going on. Their share price looks long-term, looks amazing. It's just broken out to a beautiful new up leg that could have really big legs. It is overvalued, but the chart is showing it could go a lot higher. So if you weigh the technicals and the fundamentals, I mean, fundamentally, it's a little rich, but the long-term picture of this chart is extremely bullish.
All right. And James, I have 10 seconds left. Final thought versus Disney. I mean, would you buy Disney over these guys or?
Absolutely not. I would not touch Disney with a 10-foot pole. Bullish on gaming, bearish on Disney.
That was good. And I think that was in under 10 seconds. Good to see you both. Chris Vermeulen, founder, chief market strategist, thetechnicaltraders.com. James Cakmak, partner, Clockwise Capital. Great conversation. Thank you both so very much.